Hello, good morning. This is Owner's Equity Part 2, Bennett Tchaikovsky, CPA ESQ. Um, Disclaimer and copyright. This presentation is copyright 2008 to 2018 by Bennett Tchaikovsky. The opinions in this presentation are that of the author and the author alone and are not the opinions of the author's employers, including but not limited to Irvine Valley College and or the South Orange County Community College District. The information contained therein is not meant to be any legal or accounting advice whatsoever. And I apologize for that little, there you go. Okay, so we're back here to our second video here on common stock, or I should say on owner's equity. The first thing when a corporation forms, they create a certain number of authorized shares. Now, this here is for Home Depot that has about 10 billion shares outstanding. So as a company starts, they're not necessarily going to be at 10 billion, but they could get there. And how do they do it? There's going to be an initial amount of what we call authorized shares, or how many shares is this particular corporation authorized to issue. And the company can increase the amount of authorized shares whenever it wants to do so. And they'll generally get a board approval. And then once with board approval, then they can go through and move forward with it. But here, could Home Depot authorize additional shares? Sure. They can, you can do what you want to do as a corporation as long as you have that shareholder approval. So that's authorized. And again, the common stock is really a company's currency. How is the company deciding to use this currency to raise money? They're taking this currency and turning it into cash by selling it. Companies, again, what's the advantage of selling stock? Don't have to pay it back. The disadvantage is you lose ownership control. Unless you're Mark Zuckerberg and had the foresight to create two different classes of stock before you went public. So there you go. Anyways, what is issued? And what issued means is how many shares has a corporation sold publicly? Meaning that, or I shouldn't say publicly, but how many shares has the corporation gone out and sold or issued out to other people? And outstanding is, well, the issued and outstanding can be the same number, or it can be different. And why would it be different? Well, here in this example of Home Depot has repurchased about 637 million shares of its own stock. And we'll learn about that a little bit later. But that is what we call treasury stock. And so that's why the issued and outstanding are different. If a corporation has issued shares, that means either sold them or given those shares out. Outstanding is, well, those issued shares, how many remain with investors and how many has the company repurchased. Okay, so if we look at here, we see here what we call a par value. And you see this is here is about 5 cents, which to me is a little bit high. But what is par value? It's an arbitrary value typically set at a fraction of a share price. And this is the minimum legal liability that a shareholder has to a company. This is why when I look at most accounting textbooks and I cringe because I see, oh, they're saying it's a $5 par value per share. Unless you're Berkshire Hathaway, which sells for about 80 grand per share, who's never split their stock, that's okay. But generally, you want to be 0.0001 or something around there. You want to be a very small amount. And that way, you really never have to worry about a shareholder having to make up for par value. If you sold below par value, the shareholder may technically owe the difference between par value and the price they actually bought the stock from the company for. So again, when you're seeing this here, and that's important to an investor, because once they buy shares, they don't want to have to come back and kind of say, all right, well, you got to pay back more money. So it's something that we want to got to keep in mind. But for our purposes, when we see par value, it's just a designation of we have to assign a certain dollar amount to the par value and the rest to additional paid-in capital that we'll see shortly. So if par value is arbitrary, what is market value? Market value is essentially what a willing buyer will pay a willing seller for stock in a transaction. And if I look here, let's go back. So what is market value? If I type in Amazon stock price, and I see right here, this is talking about market value. So this is the market closing price here for Amazon. That's what market value refers to. Okay. So when we looked at before, when we were issuing stock before in our early chapters, here we have Saba Inc. Invested $100,000 in the Leanne, with SI receiving common stock. So to prepare the journal entry for LI, we debited cash, credited common stock. But however, this was not really correct, because if a stock has a par value generally, which it does, we need to determine the amount that we're first allocating to par. Now we generally go through and do this to you. We're lying to you as accounting professors, and it's mainly because when you're first learning about how do you generally go through and record transactions, you're going to be so completely overwhelmed that sharing this kind of minutia is better served in a later chapter. But what's really important to remember is that when we are issuing stock, we do need to initially record an amount at par. So here, how do we do it? Let's look at the same example, but with par value. So assume the same facts. In example one, except that SI purchases 1,000 shares of stock at $100 per share. The stock has a par value of 0.001 per share. The first thing we're going to do is we're going to compute the cash proceeds, which are going to be 1,000 shares times $100 per share, or $100,000. Debit cash for $100,000. We're doing this for Leanne Inc. And then we're going to determine the amount that goes to par value. So we first assign it to par, which is going to be 1,000 shares, which is from right here, times 0.001 per share, or $1. And then the remaining balancing amount in terms of what I need to do in order to balance my journal entry is going to go to additional paid-in capital common stock. You will also see this as paid-in capital common stock. What does that mean? It just essentially means you have par value, which is the first you're setting, and then you're going to have an additional paid-in capital amount, which will be that excess amount over par. One of the other things that can also happen too, so this was the previous example here is we're getting cash. Cash is very easy to determine. Cash is cash. But what happens when we're, say, receiving services, or we're go ahead and maybe we get a patent, or we get some land? What do we do? And so when the company is issuing stock for something other than cash, what we need to do is to value the transaction using the fair value of the stock or property or the services, whichever is going to be more easily determinable. So what we want to use here is our better judgment in terms of saying, how should we go through and record this transaction? So I'm going to give you kind of an extreme example than something that's going to be a little bit more sensible. So we have here IRI is providing investor relations services to 420 Inc. What are investor relations services? These are very, very important. If you don't know what they are, take a look at what they are. It's essentially, how does a company, by using an investor relations firm, keep up communications with shareholders. Extremely important function. So we have here 420 Inc. In exchange for common stock on 6/30/19. Now, 4i is a privately held company and has not had a recent stock issuance, but 4i believes that the value of its shares is over $1,000 per share. IRI has provided 200 hours of investor relations services and typically charges similar clients $400 per hour. 4i gives IRI 8,000 shares of 0.001 par value stock. So there's really going to be two different ways we can value this transaction. Now remember, we're not receiving cash. Instead, what's happening here is that we're getting services. So what we need to do is look at the value of the stock, compare that to the stock value of the services, and see which one here is best. And what is the better value to use? And so right here, there's a couple different factors. One, the stock of 4i has not been issued recently. So this $1,000 per share, this is something that where 4i believes it's the amount, and they haven't had a recent stock issuance. So the stock hasn't been issued recently. 4i is a privately held company. Remember, if a company is publicly traded, then that can make a lot more sense in terms of, we can easily determine the value of the shares, but it's private, so it's not going to happen. And the investor relations services are somewhat more grounded in reality because here, well, they similarly charge similar clients $400 per hour, and it's 200 hours. So that might be the better one. Also, and this is kind of a counterpoint or a counter argument, because if 4i really thought that its shares were worth $1,000 per share, would you really give 8,000 shares or $8 million for 200 hours of IR services? I don't know. Sounds like how much we're going to play LeBron to play for the Lakers. All right. So right over here to record the entry, the fakers. I mean, I don't know. I'm not a basketball guy. So here we go. So we have here, we're debiting investor relations expense, or what we actually received. We debit common stock par. Now remember, for common stock at par, we're taking the number of shares being issued, which is going to be 8,000 shares times 0.001, and we get 8. And similar to the last example, right here, that remaining amount is going to go to additional paid-in capital common stock. How did we get the 80,000? 200 hours times 400. How did we get the 8? It's 8,000 shares of 0.001 par value stock. If I multiply those two together, I should get 8. If they don't add up like that, I'm sure I'll get a comment below. Then we have here additional paid-in capital common stock. That's going to be the difference between the value that we're assigning to for the services less the par value, or $79,992. Okay. Let's look at another example. And here we are, there's now performing IR services, but we're changing the fact pattern. 4i is now a publicly traded company whose stock is actively traded in the markets. Remember, what's going to be the best valuation? Now, if something's actively traded, that might be closer to real currency. The most recent closing price of 4i stock was $20 per share. IRI has provided 100 hours of investor relations services and typically charges similar clients $300 per hour. Again, I'm changing the fact pattern. 4i gives IRI 1,000 shares of 0.001 par value stock. So here we've got, if the market price is $20 per share, the value of the stock is 20 grand, value of the IR services is about 30. In this case, I would probably use the value of the stock. And because it's in an actively traded market, meaning there's a lot of shares trading. When we looked at Amazon, there's a lot of, when you see that indicator where it says volume, that tells you how many shares have traded in a day. You can also go through and look at volume, and there's some thinly traded stocks. So again, depends on the type of market you're in. And so right over here, you're going to be essentially using the market value of the shares to determine the amount of the investor relations expense. For those of you who have a further interest in learning about investor relations, yours truly has written a few articles that came out a few years ago, but they still kind of hold true. Those can be found on my faculty website at ibc.edu. And if you go there, you'll see how to make investor relations more accountable. There you go. Okay, preferred stock. So with common stock is one way to go through and raise money. And oftentimes common stock is going to be used for most issuances to founders, to possibly to angel investors, to in public markets. But when we get to fundraising, oftentimes, and it's especially true for privately held companies, most investors are going to want to find a way to protect themselves. And what they really kind of worry about is, will this company go through and do some crazy things? And companies can do crazy things, but investors really want to ensure that their investment is secure. And why is that? Well, if you're investing in a private company, you can't really turn around and sell your shares. There are some exchanges in Silicon Valley or in Silicon Beach where if you're working at certain types of companies, you can find people to buy your shares. However, here, most companies will kind of say, look, or most investors say, look, if you want me to go through and invest, I want certain terms. And what you can do, and again, preferred stock, this is a way of essentially, it's a different class of stock than common. And what preferred stock can do is give the investor certain types of features that are more preferable over the common shareholders. And these types of features that I'm going to list out here, these are all going to be determined during negotiations. And it's usually going to be between the company and its investors. They may use the company may use an investment bank. The investors may appoint a lead investor, but all these are different features of preferred shares. And again, with securities, you can create different types of classes. You have different, class A preferred, there's all these different things you can go through and do. Again, it really depends upon the way you're going to be structuring the capital for your business. But what you can do here is that they can have a preference over dividend distributions, also distributions of assets and liquidation. Remember that if I am a common shareholder, I'm the last one to the bankruptcy party. And it's not a party, it's a party for the attorneys because they always get paid. But in this case right here, I'm the last person at the party. The preferred stock can also be convertible into common stock at a certain price. What does that mean? Well, convertible means you take the common, it converts to take the preferred stock, and then it can convert, meaning I can go from preferred to common at a certain price. When most companies go public, you will see that the preferred shares ultimately become common shares. And that's really more of an important thing where once you do go public and your market is your stock is kind of really starting to trade in the NASDAQ or the NYSE, to really reduce that investor confusion, you really only want to have one share of stock to kind of reduce that uncertainty. Callable features. What does callable mean? It's a feature where the company can repurchase the preferred stock at a certain rate for cash. The preferred stock can also have a stated dividend rate. And participating, this is a feature where if the preferred shareholders are paid a dividend, then the common shareholders are paid the dividend, and then the preferred stock could potentially participate in other or other distributions. Again, all of these features are really going to be negotiated out. There's not one, you have preferred stock with nothing on it, and you can have preferred stock with everything. It just depends. And here you've got may or may not have voting rights. You can have non-voting preferred versus voting preferred. Remember that common shares generally all are able to have voting rights, with the exception of Facebook. So here we've got cumulative versus non-cumulative dividends. What does that mean? If the dividend on a preferred share is cumulative, that is going to be carrying over. It doesn't mean that dividends are going to be forced to be paid. Rather, if dividends are paid, the dividends from the prior years first must be paid, then the current years, and then the common shareholders can be paid. Non-cumulative is essentially that the undeclared dividends from current prior years do not have to be paid in future years. And I love how I spelled that completely incorrectly. Good job, Tchaikovsky. And then why preferred? Again, it's a way to raise capital potentially without sacrificing control, also giving the investors a way out, boost return earned by common shareholders. And, again, you can be appealing to investors who might believe that common stock is too risky or the expected return on common stock is too low. Again, using preferred stock, you have investor wants to invest in company. What vehicle do they want to go through and invest with? One side note here, all I will tell you is that whenever you are selling your company to somebody, whether it be to another company in full, or you're selling it to an investor, or you're selling shares to an investor, make sure you do your diligence and see who's investing in your company. You need to do thorough diligence. It is very, very important that you know who you are dealing with. I cannot emphasize that point enough. You need to know who you are in business with. Doing a quick web search, if they've got a checkbook, it's not good enough. You need to do your diligence, because if you have a caustic or an investor that's going to cause you problems, you need to be aware of that going into the transaction. Okay, so I think this might be a good place to break, and we'll kind of take up our next topic, which will be dividends, just momentarily. So I want to thank you for joining me today here on Common Stock Part 2, or Share Owners Equity Part 2, Electric Boogaloo. I can't steal that from Canon Films, only they get that film title. This is Bennett Tchaikovsky. Thank you again for joining my presentation. If you could please like and subscribe. Thank you so much, and I will see you on the next video.